And welcome to this session of the Capital Markets Conference at NYU Schack Institute. We are very excited that you're here with us today for this panel. My name is Dustin Jones, and I'm the academic director here at the Schack Institute. I have the privilege and the honor of working with Dean Sam Chandon in overseeing the Schack Institute, along with my colleague who oversees the undergraduate programs. I focus on our three master's degrees at Schack. We have a master's in real estate, master's in real estate development, as well as a master's in construction management. We have a fantastic cohort of faculty at Schack Institute. We have the largest full-time faculty of any academic institution in real estate, and the large faculty that hail from industry all around the country, primarily in the New York City region. I'm excited to be able to be with you this day on Veterans Day. We recognize the veterans that have served the country, our country so well, in these interesting times that we're in. Want to make sure we give them a shout out and thank them for their service and their dedication and for the freedoms that we all get to enjoy. Here during this session, we're going to have, this is essentially a reprise of a session that we did last summer that was in June. That was entitled The Black Experience in Real Estate. And we had brought together a number of our industry professionals, along with myself and some other faculty, to discuss where we're at in the moment. At that time, you can imagine in late June, where we were at and we were feeling. This was shortly after the George Floyd incident, death that we all witnessed, that we all had to endure. And there was definitely a question of whether we were in a moment or a movement and what was going on. So we wanted to have this panel and bring this back today. It was one of our most successful and well-attended panels over the summer. Wanted to convene a session and bring this back today during the Capital Markets Conference. And we partnered with the Real Estate Executive Council. And I have with me today three distinguished members of REIS, the Real Estate Executive Council, with us today. Jim Simmons III is the managing partner and CEO of Asland Capital Partners. In his distinguished career over a number of decades, we'll say, has been responsible for managing and originating and structuring real estate transactions and strategies, including different portfolio acquisitions and management. He's the vice chair of REIS right now. We also have Tammy Jones, who's the founder and CEO of Basis Investment Group. If you're not familiar with Basis, you should, and you will be by the end of this conversation as well. Tammy, Basis has placed over $4 billion in commercial real estate debt and equity investments over the past short years. She's on the board of Mac Cali. She's also on the board of NYU's Schack Institute of Real Estate. She's the current chairwoman of REIS. She's also on the President's Council for Cornell Women, which is a very distinguished organization of Cornell alumni, her alma mater. She's also, just within the past hour and a half, the 2020 Cornell Real Estate Industry Leader Award recipient. And so she just received that award today. That is a tremendous honor given out once a year by the Cornell Real Estate Council, the Alumni Association. So we're excited for her to be here with us today as well. We also have Ken Mcintyre, who is the CEO of the Real Estate Executive Council. Prior to his term at REIS, Ken was the managing director at MetLife Real Estate Investment Group. He's also on the board of Newmark Group, and he was a former executive advisor to the Office of Diversity and Inclusion at the Port Authority for New York and New Jersey. So we have a distinguished panel of individuals who are part of the commercial real estate industry that have seen a lot of things, experienced a lot of things, have an insight because they're part of REIS. And one of the things that just happened in the past couple of days is that REIS had a two-day conference on the state of diversity, equity, and inclusion, where they had a number of panelists that presented to their members during that two-day virtual conference. And so this is an opportunity for us to share some of the things that came out of that meeting, came out of the conversations and discussions that REIS had collectively amongst its members during the conference, that we can share and discuss amongst ourselves in this kind of more of a fireside chat amongst friends, including all of you who are watching this virtually. So with that, I want to turn the time over to the chair of REIS, Tammy, and then I'd like to have Ken, who's the current CEO, and then Jim, kind of just give some reflections, some thoughts on some of the things that you heard that came out of the conference from your membership. Tammy?
Thank you, Dustin, and good afternoon, everyone. It's really exciting to be back speaking to the group that through NYU Schack. We know that there's a large audience, and we're hoping that you guys get something out of this. So what did we do over the last couple of days? Well, as Dustin said, we hosted a conference on diversity, equity, and inclusion. And the purpose of that conference was to shine a light and continue to shine a light on some of the discussions that we have all been recently holding with respect to changing the face of the commercial real estate industry. Now, we talked about whether this is a movement, whether this is a moment, and I'll just jump out and say that I think that there's a shift, right? And there's still a lot of conversation happening about ways to improve D&I. And so the purpose of our conference was to really break down each of the areas that REIS is focusing on. And REIS is the preeminent professional trade organization for African American and Latino executives in commercial real estate. And we are a national organization. We have been doing the work of D&I for almost 2 decades. So this is not new for us. And what we wanted to do was to really break down where we're focusing. And we're focusing on 5 areas. I'm not going to go into them in depth because we're going to talk about them. But the first is the ecosystem, which we're going to discuss, which is the pipeline. The second is making sure that we are helping industry leaders to know that they need to have a diversity business plan. We'll unpack that a little. Third is access to capital and credit, topic of this conference. The fourth is, minority spend. Who are you doing business with, and making sure that we're coming forward with ideas on how you can increase your minority spend. And finally, it's partnership, which I always say that there's one thing that the real estate industry does well is we partner. We do it all the time. And so this is a time where none of us can do it alone. We absolutely have to partner. Majority firms, trade organizations that are need to affiliate with groups like REIS, because if you really want to affect systemic change, then we have to come together and collaborate. And so hopefully we'll get into some of those areas.
Ken?
Yes, thank you, Dustin, and thank you for NYU for hosting this panel and inviting us. I'll just add a couple of comments about the REIS conference that we had the past couple of days, and more importantly, why REIS is important as an organization. What we're seeing increasingly is, even though the percentage of minorities involved in the real estate industry is a very low number, as we all know and we all see as we travel through real estate circles, the absolute number of people of color in the industry has been growing over time. And what REIS does is find people who are in executive positions, people of color who are in executive positions across the real estate landscape. And we created an organization that is building a community across that group. And what's important about that community is that we can support each other, we can provide each other with information across different disciplines in real estate, and we can provide ourselves as role models for future generations coming into real estate. And so a very important part of us holding a conference like we did yesterday was just so that people can actually see that there are, several, we had 20 plus speakers over 2 days, the majority of which were people of color, all in executive positions in this industry. And so if you are a young person of color with any interest in coming into real estate, you can see that there are people of color who have been successful, and we're trying to show that there's a path there. So that's been one of the important outgrowths of what we did over the past couple of days.
Ken, if I can ask you before we go to Jim, and just as you're talking about the conference, in terms of the membership, the makeup of the people that are attending the conference, are in REIS, are they developers, are they investors, are they the capital side? We have a broad audience of folks that are watching this presentation, part of the NYU network, that do a variety of things. So your membership are made of just bankers, just CEO types? Who?
So yes, a great question. Our membership spans across the whole spectrum of real estate. We have developers, we have investment managers, we have people focused on affordable housing, we have people in economic development, we have people involved in construction management, we have brokers, we have lenders, we have corporate real estate, people who work for corporations and are on the facility side. We have title people. So we're trying to capture all aspects of real estate. And as I said, show representation that there are people of color in all of these areas. And so wherever you're trying to go in real estate, there's somebody there that we can provide you as a role model, maybe even a mentor, and at a minimum, at least with a representation. Two is whatever you're trying to do in real estate. There's somebody of color you can call who could probably help you, give you some direction, or work for you along those lines. And so we'll talk about that later. And then the third thing is that no matter where you are in the real estate industry as a person of color, you don't have to feel orphaned, because there is a big community of us, a growing community of us, and Reese is trying to make that community more visible to everybody of color in the industry.
Thanks, Ken. Jim, reflections, thoughts on the conference?
Yeah, Dustin, I too want to echo thanks to NYU and Schack for having this important discussion. The way I personally view the world is the good news is that we are talking about diversity and inclusion. The bad news is that we are talking about diversity and inclusion. I mean, this is a conversation, and I'm a child of the 60s. So this is a conversation that's been held certainly the entirety of my life. And the things that my parents fought for are still goals yet achieved. So the importance of the conversation still persists. Part of the I guess part of the thing that is troubling about this time is that it took an event like George Floyd to bring many of these issues to the fore, and not to the fore of our minds and our collective consciousness, but to the fore of the minds of the country and to the minds of the individuals who can actually effectuate change to help ameliorate the issues. Mm-hmm. So none of us will look the gift horse in the mouth and saying that because of that we should not focus on it. But it's not a great feeling that the death of one is what has led to a lot of the change in dialogue. Now, you asked the question, is it a moment or is it a movement? I don't know yet. Yeah. I don't know.
That's where I was going to open up with all of us, because when we were in June, when we were all, I remember when Dean Chandon asked me to be a part of that panel. I mean, it was mid-June. I mean, the protests and manifestations were still going on, demonstrations. It was a volatile time, and I think I was feeling the emotional burden of like, oh my gosh, like, are we here again doing this? And like, that we need to talk about these issues. And I was having conversations with folks, like I think, Jim, what you're alluding to, that had never had these conversations with me about these topics. And it was at the forefront of their mind. And part of me was like, finally, thank you. Yes, I'm glad we're having this conversation now. But I think we're all wondering, was it just a moment? Have we moved on from that? Or where are we? I mean, we just had an election last week too.
I think that it certainly has spurred conversation such that the topic is higher on the totem pole than it was before. I think that it has spurred some action in very specific areas where the immediacy could be felt by things that could be implemented very quickly. So, for example, I don't know the exact numbers, but I do know over the first 3 quarters of the year, there were more people of color who were put on corporate boards than the prior 2 years combined. Right. So that is an immediate effect of
measurable, right?
Is the post George Floyd world. But part of the issue is that it wasn't enough that less than 1% of all assets are managed of institutional capital managed by individuals of color.
Mhm.
I mean, the inherent unfairness of that was not recognized, and by itself jarred people to action and say we should do something about this. Or the fact,
Tammy,
Yeah, and I was just going to say, I couldn't agree more. I mean, Jim and Ken and Dustin, this is a real fireside chat because we've had this conversation many times. I mean, it really, we certainly need change, right? And we've needed change for decades upon decades. And I think the thing that was, I guess, frustrating to me, just, I'm a hire in commercial real estate from an attempt at diversity and inclusion. And when I think about my 20 plus year career, I still don't see a pipeline, ahead of me or a pipeline behind me that reflects those efforts. And so what that tells me is that we're doing something that it doesn't have the effect that we're intending, or we're not as focused on it that as we should be. But either way, we need to just basically throw out the old model and do something new, right? And that's what I think we're trying to do now. And I will tell you that with the election, with the pandemic, with all of the chaos that we're all feeling, I do feel like this has taken a little bit of a couple of steps back. And I think that was one of the reasons why Reese wanted to continue to have this conversation. I definitely think that it's not put it back in the.
what do you mean a step back? Like what?
I don't feel the same level of urgency that I felt a few months ago. I just don't. I'm going to be really honest. I feel like
as in June when everything was happening.
There was an intensity that was overwhelming to me as a Black woman, to me as a mom, to me as a business leader. I sort of feel like it's there, and I'm still, I think the three of us and the four of us are still talking about the issues, but I don't feel the sense of urgency. Now that's to be expected, but we have to keep pushing. And I think that Jim is right. There were a lot of reactive moves, right, that were made, and we'll take them, right? But my girl RBG, Cornell alum, says that real change, enduring change happens one step at a time. And I really think that people that are just throwing up flares and just throwing spaghetti on the wall to see what sticks are not really going to change anything. And so we have to stop these efforts that are not going to create systemic change. And that's why we're focusing on pipeline and entrepreneurship. And creating entrepreneurs doesn't happen overnight. It takes time and thought.
Ken, I cut you off. I think you were going to say something as well.
I would just add that, every movement starts with a moment, but it needs momentum.
Yeah.
And one of the things that we were doing with our conference the past 2 days was trying to continue the momentum. I think that's what Tammy was saying. And I would also say that even though whether it's a movement or a moment, from a Reese perspective, this is our mission. This is what we were created to do. And as Tammy said earlier, we've been doing this for almost 20 years, and we will continue to do it. It's just the news cycle has now created a category for us that's diversity, equity, and inclusion. But that every initiative that we've undertaken has been aligned with those objectives since our formation. And now we're trying to grab as much wind in our sails currently so that we can continue to scale and achieve what many firms and people in light of the news cycle have said they also want to achieve, but they've only said that because the news cycle, to Jim's point, brought it to the fore of their minds.
So has there been any change in terms of capital raising? Tammy, this is what you do. Are you hearing more investment managers say or express an interest? Are you seeing that in your experience, even in the past 4 months?
Yeah. So I mean, it's informal. But what I will say, there's been a renewed conversation. I think organizations and institutions that may not have been as focused on who is managing their capital, people are asking the question, which is really great. I mean, we've been asking this question forever of, public pension plans, and endowments, and foundations, and university foundations. And we've been saying, look, your student body looks like me, and you don't have a single investment manager that manages your capital. Why is that? And so now, whether people will pull the trigger, we have to come back in 4 months.
Mhm.
But
This will be an ongoing conversation,
it
obviously.
will be. But I am encouraged with quotes that there are conversations, places that our members are getting into the rooms of capital sources that would have otherwise not been as open. So I do think so. That's encouraging, and it's this is the thing, and I have to say this. There's a social impact thing, but like let's face it, and as an institution, NYU Schack knows this. Diverse teams produce better outcomes. Study after study shows it. McKinsey has a report. The Financial Times just came out with a report from a global asset manager that talked about the returns that were higher with diverse teams that were women and minorities. And so it's the fiduciary responsibility of whoever manages is controlling the purse strings of these LPs to actually want diversity in their managers too. It's just like portfolio diversity. And I feel like we keep making this argument, and I don't. It is a social good for sure, but it actually is good for your bottom line. And so that's and Reese has been talking about that and saying that for years. And so finally, I'm thinking that people, if you need a reason other than the fact that it's something that is good to do for social impact reasons, but the other things in addition to returns, we invest together and we hire each other. And we have a wealth gap situation that we're trying to address. For all of those reasons, it's like there's no report out there, Dustin, that says that our returns are lower. So that's another way to look at it. If you don't want to believe that they're high.
Yeah, that's good to know.
But Tammy, if that's the case, right? If the performance is superior, or at least at a minimum on par, but we know and would argue superior, then that begs one to question: why are we not getting more capital? Because if from an investment manager perspective, your part of your job and part of your fiduciary responsibility is to generate the highest returns possible, all things being equal. So if everything else is equal and the returns are higher with diverse teams, then what's holding the equation back?
I know. We're looked upon as risky. They think that our operating models are not as strong. We're smaller managers, and so that means risk. And so that is a tremendous burden, irrespective of the fact that many of us have rolled out of institutions that have managed money for many years, irrespective of the fact that we have to go through a diligence process that's the same as any other platform. We just have to, there's unconscious bias in many of these decisions. And that's what we have to break down, because we have to be real, right? And so, as Jim said, if there's no other reason, then it's about risk, right? It's about feeling like I don't know.
It's a perception of risk.
A perception of risk. That's a better way to say it. I don't know you. I want to do business with people that I know, feel comfortable, maybe are more like me. And so that's what we have to break down. I mean, that's just the way it is. And so at the end of the day, and I'll just tell you a quick story. When I went out to raise my fund, I decided that I'm tired of talking about why it isn't and the risk. And so what I tried to do was de-risk my model. And I created a seed portfolio that said, okay, it's not a completely blind pool. Here are 8 investments in what I said I was going to do. And so now you can see that I can actually do it. I'm achieving the returns and trying to take some things off of the table with respect to the perception of risk. And it did work. But you know what? We shouldn't have to do that, but it was a strategy. And then I was able to raise around the capital. Now, do I know that that's the answer? I don't. But I will tell you that that's what when I'm talking to other people about raising capital, it's focus on how you can make sure that the perception of risk is mitigated. And that's a very hard conversation to have. And as a result, the pipeline is not as robust.
And to your point, the effect of that is that's a hurdle that you had to overcome that we know others have not been faced with.
That's right.
We can name names of groups who have rolled out of shops, and they magically appear with $1 billion or multiple hundreds of millions of dollars with no infrastructure, no team. The proverbial three people who rolled out of Shop X, they hung their shingle and then they have $1 billion the next day. I mean,
Because they don't have that perception of risk.
Not at all.
Yeah.
And I think Tammy used the term the unconscious bias. That term oftentimes evokes a lot of emotion. A lot of people will wince when you use that. But I think you're absolutely correct. It's an unconscious bias, but it's a perception of risk. I think is more kind of the commercial term that's used for it. That's unconscious. Right. Unconscious perception of risk. No different than walking down the street, my son and I, and have the woman cross to the other side of the street because she thinks two dark-skinned people are going to do something. I'm like, are you serious? Like, come on, because of a perception of risk. But this is how it plays out in business. I was like, I don't know if they can perform. I don't know if they can deliver. Let's wait.
Sorry, go ahead, Ken.
Real quickly, the outcome of that is a systemic, challenge to us that maintains the status quo. And what I ask all the time is, look, if the demographics of the country are moving in a certain way, and the demographics of who you're doing business with isn't changing, then you need to identify why your organization is fighting demographics. What are the systems in your organization that fight demographics? And so when you look at it from that context, I think managers and fiduciaries and trustees, that's one of the ways they need to look at it is, how come we don't have diverse managers if the whole population is becoming more diverse?
So let me counter, because as an attorney, I like to play devil's advocate a bit. What if
that's why you play devil's advocate?
The institution says we have a colorblind policy. Anyone that comes to us with an investment strategy that's worth investing in, we don't look at race. It's colorblind. If that's the response, how would you?
I would just point to the outcomes. I won't argue with you whether you're colorblind or not. What I can say specifically is that people of color get disproportionately less allocations of capital. So you may be colorblind, you may not be, but at the end of the day, the results for equally qualified, and I might argue overqualified people of color. I can tell you for a fact that as much as I love education, I don't have 2 master's degrees because I love education, right? It's because those were the tickets that I had to punch to credentialize myself and to prove to the world that I was intelligent enough, smart enough, diligent enough to do whatever it was I desired to do. And that question could never be asked, is this an intelligent person?
That's right.
Once that question is answered, there are other questions that arise that aren't asked of other people who are less credentialed, less experienced, less of a track record, that receive allocations.
And it's surprising, Jim, considering the Princeton undergrad wasn't enough, you had to go get 2 master's degrees.
Yeah, and you'll hear that theme over and over again when you talk to commercial real estate executives of color. But I was just going to say, the thing that's so crazy to me is it's back to what I said before. It's sort of portfolio theory and diversification 101. How could you possibly think, to counter back to you, Dustin, that all white men are better allocators of capital? Because that's what we're saying, right? 1% of the 70 trillion of AUM globally is managed by people of color, less than 1%. And so that's not a lot of money. So that means that the rest of the money is going somewhere else. And so that doesn't make sense. So it's not that you are, if you say you're not colorblind, you really are, because you have to look at who you're doing business with. And the thing about it is, it hasn't extended this whole diversity and inclusion thing. I believe it's easier to deal with hiring. I really do. Because when you start getting into wealth creation, you start getting capital, it becomes a whole different conversation. And so that's why hiring, I don't get me wrong. And we talked about this. The ecosystem is important. It starts with academia. It starts with high school. We have a high school program that we've exposed 400 kids of color to real estate. So we get that. But we are not going to stop with that, because this wealth gap thing is real, guys. I mean, 17,000 in net worth for a Black family versus 171,000 for a white family in the Federal Reserve's most recent study, that the difference on those balance sheets is real estate, and it's access to being able to borrow against your real estate to create wealth, to send your kids to college, to have businesses, and all of that stuff. Our industry is really an offender, and it's because of two reasons. It's a closed network, and it's a legacy business, and we just have to, I like to shine a light on things and not pretend. And so what we have to do is break down those areas of being able to hide behind that. We had a panelist yesterday, Chad Treadway, who couldn't make it today with us at JP Morgan. And he talked about something that had to do with access to opportunity and exposure. And he talked about the fact that many white families, particularly real estate families, they sit down with their kid and they're giving him oatmeal and peas, and they're talking about cap rates, and they're showing him the building. And guess what, guys? I didn't grow up that way. I grew up in affordable housing, and so that same kid that we showed the industry to was in our program, and so there are barriers, there are hurdles that I don't know. Like, I've always been taught to just outwork everybody, to just keep your head down, and if you work and work and work, and yeah, we have all achieved some success, but the barriers and hurdles are real, and we have to just. If we're serious about making change, then we have to partner. We have to actually say, yeah, that is a messed up barrier. And I'll tell you, when I raised my fund, I can trace every dollar to a minority or woman in that process somewhere.
That helped with being approved?
Some way for me to get in, because it's a relationship business, even in capital raising.
And the comfort level,
or giving, or someone willing to give you a chance. Because at the end of the day, that's all we want. Like Jim just said, he's intelligent, he knows what he's doing. If you give him a chance, or if you give me a chance, right? And that's what we're trying to do, is say, we're not really asking you to do anything other than give us a fair chance, because we're gonna come bring it. We have to.
Jim, you look like you were gonna say something.
No.
Oh,
Tammy said it.
Yeah, no, we're in agreement.
Correct.
Yeah.
The hurdles are
just to clarify, I was playing devil's advocate, not because I believe that. I was just saying, some of the things I have heard people say, oh, we have a colorblind policy. We don't do that. I mean, I similar working my way up in the corporate law firm in Arizona, a very conservative state. My law firm represented the Republican Party. And so it was just a very conservative place. And we don't have a diversity policy because we believe everyone should be able to rise. And I said, but the firm is 75 years old. It's the largest firm in the Southwest, and I'm the second Black person to make partner. That I can't be the only one that's gone to law school. There have to be others. And I was in the real estate part, but that was the answer. Like, well, we don't have one. So speaking of policies, I want to go back to the ESG conversation and ESG policies. Hodeswile and Cornell published just a couple of weeks ago their annual institutional real estate allocations monitor, where they survey hundreds of institutions around the globe and survey where they're allocating capital. And one of the questions that they survey has to do with ESG. And in this year's report that came out just again a couple of weeks ago, there was an increase in the number of institutional capital that's being allocated towards ESG. 45% of companies or institutions that were surveyed in 2019 said they had a policy. So 45% said they had a policy last year. 47% said they have policies this year. The irony, though, in the statistics is that of those firms that are institutions that have policies, the next question, the corollary was how much does that policy influence your investment strategy? And then the interesting thing that came out of that is only in Australia, the Australian institutional firms, 100% of the investment process is influenced by ESG. That question is part of the process, 100%. Europe, 71%. Middle East, 57%. And then we drop way down in Asia to 27%. And in the US, 21%. So 47% say they have policies on ESG, environment, social, and governance issues. But then when you get down into how it's implemented, how it's executed, do you use it? So it's one thing to have a policy, and then do you use it? And I thought it was really interesting, and was curious to get your reaction or even your experience in in seeing the industry and capital raising and whether it's diversity, hiring. I mean, Tammy, you went there a little bit as well. Having a policy and actually using the policy.
So,
Thoughts on
yeah, I'll just jump in only because I'm the newly minted chair of the ESG committee of Mack-Cali, and many of you know that Mack-Cali is a publicly traded REIT that owns office and multifamily primarily in New Jersey. And so ESG is coming to the public markets big time. In fact, many of the advisory firms are requiring you to have an ESG rating, firms like ISS. And so what's happening is it has to be a part of your investment process or you're going to actually get left behind. There's the GRESB index or rating system, and there are a bunch of other rating systems. Some of the proxy advisory firms, by way of example, have rating systems. So when you see this stuff coming into the public markets, you know, the private real estate market better hurry up and catch up. And so I can tell you that the public pension plans also have a focus on ESG and have in the last, I'd say, 3 years and really a lot this year, are in their DDQs, due diligence questionnaires, are beginning to ask, do you have an ESG policy? I can tell you that Basis does have an ESG policy. Basis does have a social impact policy. And we started doing that a couple of years ago when no one was doing it. I know that there are companies.
But I think based on this study, that may not be enough. Do you have a policy? I think the second question is, how much does that policy influence your investments?
Yeah, no, and that's right. And so you can't just have a policy, and how are you incorporating your policy into your decision making? And that's what's really important. And I will tell you that there are a lot of real estate firms that probably are doing more and then they think they are. They just don't have a policy, and they have to actually capture it and then really go through your investment strategy, your policy, how you approach investing, and kind of marry the two. So I do think that it's coming into what is expected in investment, particularly in the public markets, and it's going to come into anyone who manages capital for public pension plans and other big institutions are going to have to really think about this. So it's a great question, and it's timely, and I think that it's actually really positive for us, because social impact, you know, investing with diverse managers in and of itself has social impact. So if you do that, you put that in your social impact plan or your ESG plan. See how easy it is?
I think I agree with Tammy. There has been a focus on ESG in a broad sense, and those decisions, or the focus, has been driven by LPs. Full stop. The question has been asked, and probably about somewhere between 3 and 5 years ago, the question started to be asked: do you have an ESG policy? I think the transition, I hope, is, okay, you have a policy, but how does that effectuate change within your organization and within how you do business on a daily basis, be it investing or not? And within the ESG tent, you have D&I. And how does D&I fit within the things that you're doing for the environment and the things that you're doing within governance? And I think that only recently has the D&I part of ESG been focused on.
Agreed.
So the question
it's been defined. It's been included more recently.
What does your management team look like? What does your board look like? Who are you? What are your hiring practices and the like? So those questions are just being answered. I think that we're still a ways away from LP saying, I'm not going to allocate capital until you have policies that help your firm, your board, whatever, reflect what your clients look like, what your tenants look like, and what the broader community looks like. I think we're still a little ways away from there. And until we get there, I'm not sure that the rubber will meet the road where real substantial change will occur in some of these larger organizations. It's happening, but we're a little ways.
And it's clearly being led by the Australian and the European institutional investors who are saying, this is important to us. We have a policy and we use it, and we're going to look for sponsors to be using it as well, to do something.
Dustin, I just want to add that I think it's a huge opportunity for diverse firms to actually get ahead of it. If you're listening
Here in the U.S.
and here in the U.S. and to actually, Basis just hired a consultant to work on our policy to make it even better and to make sure that we are adhering to the standards. We did our own policy, but now, we're going to take it up a level. And I want to be ready and make not just having a policy, to your point, and helping us to capture what it is we're doing and what else we could be doing. And so I think that that's important. So I look at that and I agree with Jim. It's not going to, necessarily make capital, take capital away from folks that don't have the policy, but let's get ready. Let's make sure that, it's another way to differentiate, because we talked about perception of risk and mitigation, but also having things that are different and that make you stand out.
I mean, from my perspective, I just want to kind of call a spade a spade. ESG, I believe it started really with the G, where the investors were concerned about the governance structures of the companies they were investing in. And so they wanted to be able to say, hey, you have poor governance structure. And so you could give them a bad rating or have a reason to disinvest in them or something like that. And then climate change came around, right? And so that became the E. And companies were like, oh, well, we don't want to be on the wrong side of the public news stories about the environment. So let's find out what companies are affecting the environment positively or negatively, and let's make them be public about that. And so then you got the E, and they throw, okay, well, what are they doing socially? And then the first part of social was, well, okay, well, do they have any women? Right. And that was their diversity version of the S in ESG, and primarily women. And last year was a record year. 2019 was a record year for women going on corporate boards for all time. And so this has kind of been it. My point is that this ESG is kind of going where the wind is blowing it. And as we said earlier, we had a news event earlier this year that shined the light on the other side of diversity and equity and inclusion. And so, that has brought it to the fore. And the point that you made about the POTUS WOW report is that in Australia, they've actually brought that in to how they operate and how they make decisions.
It's been institutionalized in institutional investors. It's just part of the process.
As opposed to like, okay, this is just a box that we need to make sure we check appropriately so that we're not on the wrong side of a news story coming out. And what we all are striving for is that decisions are made with the idea of what are you trying to achieve from an E, S, and G perspective while you're doing your business. And that's institutionalizing it. And because all E, S, and G have now hit the news cycle, I think more companies are starting to understand they don't know which is coming up next. So maybe they need to be aware on all three.
Yeah, I can always count on Ken to call a spade a spade. Leave it to the banker. We have opportunity for Q&A. So if you have questions, feel free to put them in the box and we will respond to them as we go forward. Some questions have already come in the box. There were questions that I was going to have us touch on as well, have to do with opportunity zones. So there are roughly 8,000 opportunity zones around the country that have been designated qualified zones. Are those impacting Black communities, impacting communities of color in a positive way? They've been around for about 3 years now. We have a new administration coming in. I don't assume that law will change too much, assuming it's working. But Tammy, if you had the ear of our president-elect, I will call him president-elect, what would you tell him?
So I would say that an opportunity zone is a way to shelter taxes, right? And so it does not make a property a good investment just because it's an opportunity zone. And I would say that really if you want to stimulate real investment, then you have to make sure that we're designating areas that are opportunity zones that are really going to be helpful to the community. And I don't think that all of the designations are equal. My husband happens to be working on a huge ozone project in Boston. where I believe that, it's got beachfront, it's in an area that, that is majority minority. It is, they are, making sure that they are creating jobs, including equity. And if the projects, and this is not to give his project any kind of light, this is to say that it really depends on how you're using those opportunity zones. And I think that there are a lot of people that are taking advantage of it, and are not necessarily doing the things to create wealth in the community the way, I believe it should happen. And it's sad because I think the intent of the program is positive. So no, I don't think that it's had a big splash and big impact. I don't.
So Dustin, I'm the former CEO of the Upper Manhattan Empowerment Zone, and the Op Zone legislation is based on the Empowerment Zone legislation. Right. I think that while well-intentioned and directing dollars in places that are underinvested, there were two flaws that, if fixed, could help ameliorate. Number one, in many states, won't say all, but the process of identifying op zones, census tracts was politicized in the sense that there was some rhyme or reason about how it occurred, and then in other instances there weren't a rhyme or reason other than the apparatus that was selecting them said that this is where we want it to go. Mm-hmm. Some of those decisions were predicated on where projects already existed, right? And those projects would have and could have and most likely would have gotten done anyhow. So where you really want to focus those dollars are in neighborhoods that are in desperate need for infrastructure and for investment, where projects would not get done without the OZ designation. And I don't see enough of that. I don't see enough transactions getting done that wouldn't get done otherwise.
You believe that should have been the litmus test? That's what should be the litmus test.
Look, Tammy's exactly right. It should be a good deal from an investor's perspective, but it should be a deal that on the margins, the OZ designation puts it over,
makes it gets it across the line.
That's the way the easy dollars were employed, which was, hey, it's a deal that can get done, but this will make it economically viable for a developer and the like. And I think that's the basic flaw that I see. And you have other things like trickle down from job creation that you have to make sure you're hiring for the neighborhood and the like, that I'm not sure. Time will tell how well that plays itself out.
So the question is, again, so you get a call tomorrow from the Biden transition team, and they want to talk to you about this because you've got experience, Jim. What would you tell them? You're interviewing for a cabinet position where you actually get to influence this now.
My political days are long gone. Modify it such that it achieves the goals that you intend, which is very carefully study and strategize around the census tracts that are currently selected. Modify it such that those that need the investment get it, and also ensure that the individuals who live in the census tracts in which these projects occur get first dibs on the jobs.
Would you add some way of tying the benefits to the investors to the actual goals being achieved?
Yes. It's
I guess they'd actually have to set goals.
You have to agree on what those goals would be.
Yeah. So, and then that's one of the things that I think we're all challenged with is there's no measurement, there's no metrics about what's going on with respect to these opportunity zone investments in terms of community benefits or which we thought was one of the objectives. But I'll go back to where Tammy started. The objective of the opportunity zone legislation is to defer taxes. That's the objective. Do not lose. If you go back and find who actually was involved in writing the legislation and promoting it, that will tell you why it's laid out the way it is. And the primary objective is I've got a very low basis in a equity portfolio that I don't want to pay capital gains on. So how can I diversify out of this one position into another asset class and defer paying taxes on this capital gain.
Yeah. How do I get qualified?
Just to support that, Ken, the way it's been described to me is that it's the largest wealth transfer in our lifetimes.
That's right.
Or potentially, yeah.
Largest wealth transfer or opportunity.
Yeah. Through the deferral of taxes. Yeah.
Correct. But doesn't that continue to exacerbate the issue we've been talking about? Legacy families, the business, you're just continuing. So again, if the idea of opportunity zones and creating new ones, right?
Because now it's the venture capitalists who have seed investments that are now worth billions, and they don't want to pay capital gains tax on that.
Right.
So would your advice to the new administration be we need to tweak some of these loopholes? We need to modify it? Is that what you're saying, Jim?
I think so. Look, I think that any new policy, you put it out there for a couple of years, and you go back and you analyze how it's performed, and then you modify it. I think the same argument could have and should be made about Obamacare. And since you don't throw out the baby with the bathwater, you fix it.
You fix the baby?
All right. Another question from one of our viewers. They thank us for this exciting panel. And they said they're a mid-level manager, a white male, and feel very strongly about diversity and inclusion. How can I effectuate change? How can I, if I'm not calling the shots, influence and advocate on these important issues if you're just mid-level?
So I'll take a stab at that. The way to show your commitment to diversity and inclusion is whenever you're involved in making a business decision, try to include people of color in either who could be a potential winner. It doesn't mean you necessarily give business away, but make sure that you have diverse slates on all sides, whether it's talent, whether it's where you're working with vendors, whether it's internally in terms of who has an opportunity to work on an internal project. It's just a matter of putting people up and sponsoring somebody of color so that they have the opportunity to compete that they may not have been thought of for that opportunity otherwise. That's my suggestion.
Yep, and I would just add that making sure that if you're in middle management, you can still be a beacon of light and hope for your organization by getting involved in other affinity groups that may be involved with people that don't look like you, like attending a REIS event or attending another trade organization event that has a diversity component, and then coming back to your company and saying, hey, you know what, this would be great for us as middle managers, because this is a group that could actually come in and either partner with us and speak to us. Sometimes it's about looking, I agree with Ken, the internal stuff makes sense, but also looking outside of your organization and trying to figure out what it is that you could bring to the organization, and presenting those ideas to whoever you can present them to. And at least if you're working on that, as an affiliate, right, to what we're trying to do, it's powerful. And so don't lose sight of those opportunities to try to bring new ideas to the company. And particularly now, I think now you won't be looked upon as crazy if you come and say, hey, I think we need a diversity partner right now. I think maybe, a few years ago, it might've been more difficult, but now, try. That would be my advice.
I mean, commend your effort.
I have two relatively immediate and easy ways. I'm sure that you interview those who are coming in either entry level or the like. And if you ask the question, to the extent that there are not a diverse set of candidates for a job, if you ask the question of HR, why is that the case? How do we source the people who are coming into the organization, and should we be doing a better job? And then secondarily, for summer internships and those types of programs, how are those individuals selected? And understanding that and saying, shouldn't we have a more diverse set of pools that we pull from to give this outstanding opportunity to join our firm?
The word I would add there is intentionality. It's about being intentional about being diverse and inclusive.
Because I've had
All right, we have
a question every firm I've been at. So
say that again. Say that again.
you ask it, it'll bring a different flavor to the question than if I ask.
So true. So true. I want to go back to this, the HOTUS Weil Cornell Allocations Monitor report that came out. And this is this refers to actually speaks to a couple of the questions we have to discuss here that come from the audience. Institutions outsource a substantial amount, almost 80% of their new investment allocations to third-party fund managers. Institutions continue to favor allocating capital to existing manager relationships. Emerging managers remain at a distinct disadvantage, with only 12% of institutions willing to invest with a first-time manager. So one of the questions is, if I don't have a track record, what is the best way for an emerging sponsor to position themselves to raise capital? And then the corollary to that question is, should I designate my firm as an emerging manager? Is that going to be good for me long term? Tammy.
So if you don't have a track record, it is very unlikely that you will get institutional capital, period, end of story. So do not waste your time. You have to build a track record, however.
Just based on this data, 12%.
Yeah, so I'm just saying, and you know what, I've lived it. So you have to raise capital by strategy, by deal, which could be putting together a deal. And there are some positives to that, because you don't have to have a cross promote. If we're talking about in a fund, you can raise capital by separately managed account or joint venture. And then finally, going into the commingled fund world, it's very difficult if you don't have an extensive track record. So I think, and as far as designating yourself as an emerging manager, if you don't have any assets, then you're not designating yourself. That's what you are, right? And so just so we're clear, I think the question may be, do you have to be a certified minority or woman-owned business? I mean, that's a whole nother conversation. I think that, for me, I raised about 100 million of capital that required it, literally required. If I didn't have that designation, then, you have to get a certification from a third party who comes in and reads your operating agreements and make sure that you're like not some figurehead that's a puppet, honestly. So that process has some positives and negatives, but there is some capital in certain states. I can tell you in Illinois, there is a mandate to have a certain percentage, I think it's 30%, allocated to diverse managers, and they are very serious about it. And there are other places that have loose targets. But I do think that you have to build a track record if you want to get into the investment management space. And what I did was I built the track record by strategy. Didn't go to the commingled fund world until I talked about being able to come with a de-risked model.
But is that strategy focusing on friends and family? Like who are you raising the capital from if you're not getting it from institutions?
It definitely has to be relationships. I wouldn't necessarily say friends, but some people have friends and family. I don't know about you guys, but I don't have a ton of family that's rolling with millions of dollars to back me in real estate.
No, not coming from the project.
No, exactly. So yes, the whole friend thing wasn't really an option. But through your relationships, and then ultimately some high net worth folks. I mean, when you get to our level, of being exposed to a bunch of different people, but I'm talking to the people that are starting out, right? That may not have that. And continue to just try to partner, even if you have a small piece of a deal. I always say to people, and I did this, 100% of zero is what?
Zero.
So try to partner and maybe build a track record, learn the business, get your feet wet, and then kind of build from there. And it takes time. I mean, I will tell you, it takes time.
I just want to clarify that 12% was not saying that the 12% didn't have a track record.
Right.
That 12% had a track record.
That's right.
Yeah.
The 12% was a first-time fund manager as the industry defines it. So the problem is building that track record, making it durable, and being able to take it with you, and to say that these are the transactions that I was responsible for that I actually did. I think that part of the issue of track record versus not is I have met not a few of 20 and 30-year-olds who, particularly here in New York City, have gotten backing from their families to go out and buy 2, 3, 10, 30 buildings and they amass a portfolio. And they have a track record over a 4 or 5 year period of time in which they can leverage and then go out and raise institutional capital. 20 and 30-year-olds. Whereas 40 and 50-year-olds who happen to be people of color, who have been on large platforms and have demonstrable institutional track records, have a more difficult time raising capital than individuals who take the friends and family route, as you just said, Dustin, which is not a route that's open to us.
It's a term of art, friends and family, right?
I just want to add one thing that Jim triggered for me. And don't let us make a mistake, because it's not the hurdles. It's if a person of color doesn't, meet a return, even if it's in a downturn, I can tell you that I have been compared and told about that individual's track record. And I'm like, what? Why are you telling me about that person? Just because I'm Black and they're Black?
Yeah.
You say if BlackRock loses money, or another KKR or any other firm, you don't compare them because of that. And I love both of those firms, so no offense to them. I'm just saying it. So it's not just the hurdles. And this is the real talk here, guys. We said we were going to do this. Mm-hmm. It's not the hurdles, but it's also you have to be perfect. You can't make a mistake.
Guilt by association.
Yes.
Tammy, I'll give you a story. My fund, which was a $485 million fund, 15 investments, 2007, 2008 vintage fund. An idea of that time is there are some very large institutions that returned zero.
Yes.
Not returned the money back, but returned zero. we did a double. And in my conversations with more than one LP, they spent 90% of their time talking about the one transaction that lost money out of 15.
Yep.
Or fund that did a double, that's top 5% in equity multiple for all funds of its vintage. And that's what they wanted to talk about, which was, I think, about 3% of the total AUM of the fund that was in this one transaction. We spent 90% of our time talking about that one loser, which for very specific reasons it was. That was a 2007, 2008 vintage fund, where the whole world is full of losers.
Right. So it's a different standard. It's a different hurdle. We're held to this. You can't make a mistake, and that's really hard, right? And so here we go. We're still here. We're still pushing forward. We're trying to have discussions like these to help shine a light. But it is important because it's not always the same level of treatment, and I think that the numbers back that up. And so I'm encouraged, because I want to make this a positive move, that there's an understanding that these things have to change. And I do think that as the decision makers, whoever they are, the stakeholders, whoever they are, shine a light and say, okay, now you have to answer the question as to why you have absolutely no African American or other ethnic minorities who manage your capital, when our whole pension fund looks like them. As the people that have the power ask that question, that's going to help. It will help, and it's going to take time. That's the other thing, is it's not going to happen overnight. And I'm hopeful that with the continued focus on it, and we certainly are going to continue to push the envelope. And I'm just thankful to be able to have a conversation like this, because this is what's really happening.
Yeah, I know that the hour is long, and I want to wrap up here soon. But before we part ways, we've had this nice conversation as family and with an audience watching us. And I appreciate the candor that all of us have been able to share. We've got one of the questions that someone's asking is, as a person of color, and this I think will be one of the final things we talk about, is like, what would you say to give them hope or encourage them if they want to see themselves in your shoes in the future? What could we say positive? Because we've shared, like, it's going to be a challenge. It's going to be tough. But to give them some hope for the future. Jim, you want to take that?
Why you got to start with me?
Because I want to end with Tammy.
So
I'll go back to
and I want Ken in the middle, because he's gonna go all grumpy on me.
Keep hope alive, right? No, I think that in the conversations that I've had most recently again, post GF. I think that for some of the more enlightened of those who are in the power structure, is an acknowledgement that many people started on third, and that they are the beneficiaries of starting on third. And that we didn't start at home, we started outside of the ballpark. And so recognizing the hurdles that we have had to and continue to have to surmount is what is hopeful to me, that people actually recognize it and get it and say that I am not where I am just simply by my own merits. And you are not where you are simply because you don't work hard enough or you are not diligent enough. And that's an interpersonal sort of conversation, because it takes a lot for people to recognize that. And it takes a lot to have trust to broach that conversation. And it also takes a lot for them to know me as an individual, to say, well, we know you. And we know that you could be a lot further. So it has to be something, right? It's the proof is in where you are and the pudding. So that's what's hopeful to me, is that there's a recognition that life is not fair, and that if they can help and make it less unfair, then there are people who are willing to do so. Not everyone. You still have a lot of people with the rhetoric of, I pulled myself up my bootstraps and you should work harder, and all you have to do is listen to the news or read the paper and you'll hear it. But for some subset of people who are in positions of power, they now get it more than they did before. And they're having dialogues that they didn't have before. And hopefully we can change people a mind at a time, such that it'll lift all boats.
Thanks, Jim. Ken?
So I come at it a little differently, and I go back to the sense of community and the fact that we have the Jim Simmons and the Tammy Jones out there who have done it, and there are many more. We have 130 Reese members who have done it, and we now have some ability to have connectivity across us, and as an organization, we're here to support you on the journey. Now, if you're a minority in this country, somebody at some point in your life probably told you it ain't going to be easy, and it still ain't going to be easy. But you're not alone, and that's the important thing. And there are those that have achieved, and as much as I love all that Tammy and Jim have accomplished, and yes, they're rare, but they're not really unicorns. Mm-hmm. They're humans that have achieved in a difficult environment. That is always probably going to be difficult, but collectively we have an ability to support each other, and we want you to come into this industry, and we'll be here to support you.
That's awesome. I want to say we're counting on you. We're counting on you to not give up. We are counting on you because we're doing the work, and we're trying to help make the journey somewhat better. Can I promise you that it's going to be easy? No, but I can promise you that you should get comfortable being uncomfortable, because opportunity lies at the edge of your discomfort.
Thank you, Tammy, for those closing words. I feel like we're like in the church here. Appreciate you all being a part of this. I very much appreciate the Real Estate Executive Council Reese, and for all that you all do for the industry individually and collectively as an organization on behalf of NYU and the Schack Institute of Real Estate. We couldn't do it alone as an institution. We obviously have a mission for diversity and inclusion as an academic institution. But we need industry, and we need industry associations that bring everyone together to make it work, that large ecosystem that we keep talking about. And I think that partnerships with organizations like yours is really what it's all about. And so we appreciate you being here. Our audience appreciates you sharing these words of wisdom. Very thankful for all of the viewers that have shared their questions, very insightful. And particularly, I just want to call out the white male mid-level professional that very boldly speaks out and says, "Hey, I want to advocate. I want to take up this cause." Those are the types of things. Those are the types of things that you need to do. Those are things that really mean it to us, because as we all sat around back in June with that emotional weight, we all have been having these conversations amongst ourselves for a long time. We've been experiencing these things, but something has happened in the past 4 months where the conversation has been broadened and others have come to the table to share this conversation with us. And so that was the purpose of this event this afternoon, was to allow you to join us at the table, have this conversation. You always have a seat at the table. We appreciate you being here. Thank you so much for being a part of this webinar.
Bye.
Thank you.
Thanks, NYU.